business community, from parliamentaries, from bankers, from the academia, from the media yourselves, press, the labor organizations, and some members of the public. I want to thank you all for those contributions. They're very, very valuable, and it is because of that teamwork that this matter board statement was able to be presented. Let me also start by advising that the Minister of Finance would have loved to be here, and my secretary, but they are in Zambia for the board meeting of the Zanu-PF authority, so they will not be there in person. Of course, we've got Mr. Chu, who is on the board of the bank, and who is also representing the Minister of Finance. Having said, I also see members of Parliament who are here, Mr. Mwana, who is the chairman of the budget and finance in the Parliament, and all the other members. The other members who are here, you notice here, members of Parliament and the senators who are here, please receive a warm welcome to this institution. So having said so, let me just go through my statement, and I'm also happy that you have come in numbers to listen to us in the presentation. Outside the introduction, the policy measures for the conclusion. The rest of all the other material will be put together as an annex. So this one will be a very short presentation, the introduction, policy measures, and of course then the conclusion in that order. Since the last month report statement on the 1st of October 2018, Zimbabwe has witnessed significant changes on the economic front. The economy took a different course of direction from a positive economic trajectory to an inflationary environment over the last quarter of 2018. This situation is immediately addressed in order to resolve value for money, to restore value for money. The foreign exchange premiums on the barrel market, which ranged from 1.4 to 1.8 in September 2018, increased to the current levels of between 3 to 4. This movement in forex premiums has had negative pass-through effects on inflation, which increased particularly from the September year-on-year level of 5.4% to 20.9% in October, and closing the year at 42.01%. On the positive side, the separation of bank accounts into Nostro FC accounts and RTGS FC accounts has yielded positive results as reflected by the increase in Nostro FC accounts to 551.2 million as at end of 31 January 2019, compared to 240.5 million at the beginning of October 2018, a growth of 87.6%. The significant shift in economic fundamentals during the last quarter of 2018 also increased the practice by retailers and business of charging goods and services on the basis of a multi-tier pricing system, where a single product has different prices depending on the mode of payment, e.g. US dollars, electronic payment, mobile, and or bonus. Continue to put pressure on the country's balance of payment position. The current pricing structure indicates that the majority of the transactions in the economy are now largely being conducted in electronic money and bond notes at an implied parallel market exchange rate of around 3 to 4, 3 to 3.5 US dollar. In this respect, continuing to use multi-tier pricing system, speculative pricing, loss of government revenue, valuation and accounting difficulties, asset liability mismatches, and of course, negative investor confidence. The current arrangement if maintained, will pose the risk of costly re-dollarization of the economy, which will move the economy into recession. This is evidenced by the fact that some businesses are already gradually reducing prices due to low demand in the economy. More so, some of those charging in foreign currency have also been experiencing reduced demand for their products and are therefore reverting to pricing in RTGS and components. Exporters, on the other hand, are fast becoming uncompetitive, as the export incentive scheme has been eroded by the forex premiums-induced inflation. Such a scenario is not conducive for enhancing exports and diaspora remittances. Introduction of a market determining mechanism for trading of US dollars with the RTGS balances and bond notes has become imperative. Similarly, without a formal guidance on the relative values of the RTGS, bond notes, and US dollars, the transacting public is being prejudiced through the added pricing by businesses which factor in different implied parallel market exchange rates in their pricing system. This needs to be corrected. This statement, therefore, presents policies aimed at establishing a trading mechanism of RTGS balances and bond notes with international currencies through establishing an interbank foreign exchange market to restore domestic competitiveness and to promote growth in the economy. The measures are also meant to strengthen demand for the current domestic forms of payments and to preserve foreign currency for external payments purposes that include importation of goods and services, foreign dividends payments, business and personal travel, and servicing of the country's external debt obligations. The measures in this statement are necessary to preserve the purchasing power of RTGS money and to restore export competitiveness within the economy. The rest of the mandatory statement is organized in the form that we talk about mandatory policy measures, and we also discuss outlook and the conclusion, and of course the annexes that I referred to. Section 2. New mandatory policy measures. Number 1, establishment of an interbank foreign market in Zimbabwe. The bank has taken note of the excellent contributions from the business community, parliamentaries, bankers, academia, labor organizations, the media, members of the press, and members of the public on the need to establish an interbank foreign exchange market to formalize the selling and the buying of US dollars and other currencies through banks and bureau de change. This is essential in order to bring sanity in the foreign currency market, while also at the same time promoting exports, diaspora remittances, and investments for the good of our national economy. The bank considered the implications, which include accounting, financial, economic, legal, and social implications that are embedded in the establishment of an interbank forex market within the context of the current national payment systems that include RTGS, mobile banking platforms, point of sale, bond coins, and bond notes, and bond coins. After taking account of all the implications and putting in place safeguards to maintain stability in the forex market, the bank is, with immediate effect, establishing an interbank foreign exchange market in Zimbabwe to formalize the trading of RTGS balances and bond notes with US dollars and other currencies on a willing buyer, willing seller basis through banks and bureaus to change under the following framework. A, denominating the existing RTGS balances, bond notes, and coins in circulation as RTGS dollars, in order to establish an exchange rate between the current mandatory balances and foreign exchange. The RTGS dollars thus become part of the multi-currency system in Zimbabwe. The legal instrument to give effect to this has been prepared and shall be gazetted soon. B. The RTGS dollars shall be used by all entities in Zimbabwe, including government and individuals in Zimbabwe, for the purposes of trade. F. All foreign liabilities or legacy debts due to suppliers and service providers such as IATA, declared dividends, portfolio investment, and others shall be treated separately after registering such transactions with exchange control for the purposes of providing the bank with sufficient information that will allow it to determine the roadmap for orderly expansion of the legacy debt. Foreign currency requirements for government expenditure and other essential commodities that include fuel, cooking oil, electricity, medicines, and other chemicals shall continue to be made available through the existing letters